Today we're going to take a look at a couple of the most common arguments against dividend investing. This is coming straight from a thread on the Boglehead subreddit, and if you're not familiar with Bogleheads, they're a community of people who believe in Jack Bogle's investing philosophy, which is that low-cost index fund investing is the only strategy that individual investors should pursue. Any other strategy, including dividend investing, value investing, short-term trading, or anything else, should not be pursued. There's obviously going to be some Bogleheads that are more strict than others, but I'd say on average, this group of people can be pretty vocal about other people's preferences. Some will say it's okay to invest a little in individual stocks, whereas others will advise completely against owning any individual stocks or ETFs that aren't broad market-based. While I've never been a Boglehead myself, I worked at Vanguard for years, so I know all about these people. Now, as I've said since the very beginning of this channel, when it comes to what investing strategy that you pursue, it's all a matter of personal choice. There's nothing at all wrong with index funds if that's what you prefer. But understand that people are motivated by different things when it comes to investing. Some people like to invest knowing that they own a small piece of every stock in the S&P 500 or even a small piece in thousands of stocks all over the world. And other people are more motivated by receiving regular cash payments from their investments. As long as your main strategy has proven to work and doesn't usually result in losses, then just let people do what they want to do. If I were to ask all of you, what is the best car, there would be a lot of opinions as to what the best car actually is. Some people would say that the fastest car, the Koenigsegg Jesko Absolute, is the best car. Others would say, no, the most luxurious car would be the best. Something like the Bentley Flying Spur or the Rolls-Royce Phantom. And then others would have a completely different motivation, like to them the best car is the one that can safely carry their entire family from place to place, or the cheapest well-functioning Honda or Toyota would be the best car to them. You see, it all comes down to personal preference. People pursue different things based on their own needs and their own personal taste. The investing style that you choose to pursue would also apply here. If you prefer index fund investing, that's fine, or if you prefer dividend or income investing, that's fine, and if you prefer value investing, that's also fine. But going back to this subreddit, the highest rated comment left in this thread makes the argument that dividend investing isn't a good idea because it leads to decreased diversification. It's well known that diversifying your portfolio is a very beneficial part of being an investor. When you invest in a wide range of different companies and sectors, you're better protected from things like downturns in certain industries. For example, utilities are a sector that have been negatively impacted by high interest rates, and they've been suffering for more than 2 years at this point. Once rates get cut, then we will see a recovery, but if you were 100% invested in utilities, then it'd be pretty difficult to see your portfolio flatlining or going down for more than 2 years. But holding a diverse number of stocks across many different sectors will ensure that you're still seeing growth as a whole, while a couple of sectors might be temporarily doing poorly. But this comment would seem to indicate that there isn't as much diversity available to dividend investors across different sectors or countries. To give you an idea of how diversified these Vanguard index funds are, we'll look at some of their most popular ETFs. VOO is their S&P 500 index fund, which is comparable to SPY, and it holds every company in the index. VTI is their total stock market index fund, and it holds 3,674 different investments. Then finally there's VT, which is their total world stock market index fund. This ETF currently holds 9,840 different companies. However, the top 10 holdings alone make up about 20% of this ETF. All of them hold investments across all the major sectors, including tech, financials, real estate, energy, and so on. For dividend investors looking for an intense amount of diversification, there are plenty of options that exist. With general dividend growth ETFs, they might not have any that hold thousands of companies inside them, but they are invested in all the different sectors that the Vanguard funds are. SCHD holds pretty much every single sector that you'll find in VT and VTI. Vanguard even has their own dividend ETFs, like ticker VYM, that has over 500 different stocks in it. If you do like index funds and love high dividends, then they have something called covered call ETFs that offer exposure to entire indexes. For example, SPYI has exposure to every S&P 500 stock. In addition, there's a lot of individual sector ETFs that pay dividends. They have them for utilities, healthcare, infrastructure, consumer staples, and practically everything else you could think of. Even with a sector like tech, where you wouldn't expect there to be any high-yielding dividend options to exist, considering most tech companies don't pay worthwhile distributions, there are options that exist. BlackRock has a couple science and tech closed-end funds that offer monthly dividends and hold companies like Nvidia, Apple, and Microsoft. On top of that, we also have international dividend investments, including ticker VYMI. There's also a higher yielding monthly dividend ETF for international stocks, ticker IDVO, which yields over 6%. Dividend investors are actually able to expose themselves to even more sectors than index fund investors are. We also get exposure to preferred stocks, which you likely won't find in your index fund. And also through closed-end funds, we have access to a whole host of different investment types, including warrants, emerging market bonds, currencies, commercial mortgages, and a whole host of other stuff. It is a little more difficult to become diversified for dividend investors, since with index funds, you only have to hold one of them to get a lot of diversification. My main point is, for dividend seekers, we do have a lot of options for diversification, including asset classes that are unavailable to people who only invest in index funds. A second argument that regularly comes up against dividend investing is that companies that pay dividends usually result in lower growth, or that it's nearly impossible for a higher yielding investment to beat the market. Most people know that older companies that exist, like Black & Decker, Sherwin-Williams, and a lot of energy companies pay dividends. These sectors don't see explosive amounts of growth, and so these companies know that they have to entice investors by offering a dividend. There is some truth to this argument. There's plenty of holdings out there that pay dividends and greatly underperform the market. But the very common error people make is that they only look at the share price of a holding and they do not include the dividends as part of the total return. I see this happen so often when people try to compare a dividend stock with a non-dividend paying stock. You have to use a dividend reinvestment calculator to get an accurate picture of which stock is doing better. When dividends are accounted for, even if there isn't a great deal of share price growth, a dividend-paying stock can still outperform the market. Let's take a look at some higher-yielding investments that have in fact beaten the market over the long term. These are all just off the top of my head. Realty Income, a REIT, has outperformed the S&P 500 for decades. Hercules Capital, a BDC, has also outperformed the market. Triple N REIT is another company that's beaten the market over the long term. Ares Capital, despite going through a big dividend cut during the financial crisis, has still outperformed the S&P 500. Again, I know this is all past performance, but these companies are still doing very well to this day. There are plenty of high-yielding investments that can and have beat the S&P 500. Just because a stock offers a high yield doesn't mean that it's a slow grower or that it'll underperform. So although it does take a little more effort, dividend investing does not result in less diversification. We have access to more asset classes than index fund investors. And in the case of alternative investments like REITs, BDCs, MLPs, and so on, a number of them do beat the market. In the end, if you prefer index funds, then that's fine. But if you think you might be more motivated by cash flow, then I'd suggest giving dividends a shot. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.